And good afternoon. Welcome into Market Talk for this Wednesday, January 12th. Great to have you along with us once again. I'm your host, Jesse Allen. Thanks for joining us and making us part of your day. Very busy day here in the grain trade with all the USDA numbers. We got a lot to discuss. Find us online, markettalkag.com. That is our home on the web. Markettalkag.com is where you can find us. All of our streaming sources, our social media links, latest news of agriculture, much more. It's all online, markettalkag.com. Well, as I mentioned, we have a lot to discuss. Plenty of data dumped on the trade here today, and let's talk about all of it. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us this afternoon. And Mike, good afternoon to you, sir. Undoubtedly a busy day for many folks throughout agriculture trying to take stock of all these numbers that USDA threw at us here earlier this morning.
Yeah, there's always a sigh of relief after the January crop reports out, Jesse, because the trade can mentally and psychologically move on to maybe a little bit more new crop price action, whether it's new crop price action thanks to the South American crop and how they're doing down there because they're in the heart of their reproductive phase, and moving on probably to the new crop when it comes to the U.S. acreage base as we get ready for USDA's big outlook reports and big outlook estimates and long-term projections. And so this is kind of a hallmark moment when it comes to divorcing and separating out the old crop and moving into the new year. And I think today's report probably will help us do that once again this year, especially. I think that the key takeaway for me, and this was something that I talked about in my blog post last night before the report, was my number one issue was to see if the world ending stocks for the corn, beans, and wheat would come in lower or at least low enough to offset a higher U.S. ending stocks number and potentially higher grain stocks number. And that's almost exactly what happened. And I was very thankful for that because I think it really keeps the onus and the burden on the bear. In other words, I don't think he can tread too hard into this market and press the support levels too much unless we get some new fundamentals, new policy, something that comes out essentially from a black swan type scenario now that these numbers are out.
Well, let's go through these numbers here and let's just break things down and talk about it because, again, a lot of reports thrown our way. And I think first, a good place to start looking back at quarterly grain stocks and also maybe start with the 21 22 ending stocks here. So, talk us through some of these numbers and just what you saw there on the reports.
Yeah, these are the two graphs or the two tables that I think mean the most in the old crop and mean the most to the cash side of the equation of what we've just harvested in terms of cash basis and the end users being pressured or not pressured to buy extra and hoard and continue to hoard because of the inflationary pressures and because of tight-fisted farmers. And so I think this is the more bearish or more negative side of the equation from the reports by USDA, because if you notice, the grain stocks came in on the top end of estimates when it comes to the corn side of the equation and as well as for the soybean side of the equation. So it says you've got ample row crop supplies. Wheat coming in at 1.39 billion bushels was on the lower end of the spectrum, and that's what I needed from a standpoint. If we can keep weather in the hard red wheat belt in play and very dry, I think the wheat market has a really good shot of supporting the row crops to the upside if the row crops want to go higher. But what I would say to producers right now after seeing these numbers is you may get a situation develop here where the futures does most of the upside potential. Spreads maybe stay weaker because we have ample supplies on the ground, essentially. But we also have a futures market that's trying to price in maybe more reductions in South America. And so I would look for the basis maybe to get a little bit weaker here until we see the transfer of business from South America exports to Asia over to the United States. And I think that's where these numbers help me figure out that maybe the basis is a little bit rougher here. The futures market maybe has a little bit more upside as we watch some of these other key fundamentals play out too.
Now, looking at some of the other reports as well, I was surprised, and I think a lot of folks in the trade were surprised with the winter wheat seedings numbers that came out on Wednesday, and then also the South American crop production numbers. We saw the world ending stocks. So walk us through these other three reports. Would you agree? Were you surprised by some of these numbers?
I was not from a standpoint of the world ending stocks number. I understand where you're coming from on the wheat seedings, but I really liked what USDA did because they took the U.S. Hard red wheat producer number down, and it was below the average trade guess and actually close to the lowest trade guess. And that's what I had been getting feedback from on the Western wheat belt and the hard red wheat belt, that producers maybe were a little bit scared about going after hard red wheat here, and maybe a little bit more eager to go after row crops, scared because of drought, maybe wanting to go after a little bit more soybeans. And the soft red wheat I thought was really right on the money too, because it went above the highest trade guess there at 7.07 million acres. And Jesse, I think the soft red wheat producers are seeing very good basis and very good cash prices overall, and want to kind of attack the wheat side of the equation because of the high nitrogen prices. And I think that maybe funneled into the decision making on the soft red wheat side. So I really liked USDA's numbers today. I agree with them. The hard red wheat, or I should say the all winter wheat number, was up about 2.2% from last year. So that puts you at about a 1.68 billion bushel crop. That's very tolerable, especially, as I said, if we stay dry in the hard red wheat belt and stay somewhat dry in the white wheat belt, with those numbers coming in very low at 3.56 million. So I still see wheat as a very supportive feature, thanks to the weather. So that supply-driven cost push inflation, these numbers in the wheat seedings would suggest wheat is still in that situation. The other thing that I think that blends together the world, the top chart and the bottom chart, is the world ending stocks. And this is where the corn and beans really got a dose of support from the South American crop. And this is where I think the trade is going to have to set itself up somewhere down the road here, maybe towards the end of the month, first of next month, to assume that before that next February crop report and that next data dump by USDA, we're probably going to see some lower numbers in both Argentina and Brazil, in both corn and in both beans. And so those world ending stocks stay tight. So the key, and I'll reiterate this as we close out these data pieces and these graphs, is the key here now is to see that transfer of demand from Asia going away from South America and moving over to the United States. And with a weaker dollar, stronger Brazilian currency, I really want to see, and we talked about this last week, I want to see that port Paranagua price of Brazilian soybeans in the cash market start to really go up and move above the U.S. Gulf price, not stay $25 a ton below it. So that's what I want to see the next 30 days. And then I can feel like I can get some hedges at higher levels in place.
Mike, we had some other numbers out today as well, and I know we saw those consumer price index out, the inflation data we saw this morning, some of the highest we've seen in years. I know you have an inflation chart here. We're going to pull this up. Talk about what you saw with some of that inflation data here this morning, and how that's going to play into our trade now moving forward.
This inflation situation, as I just said, is more of a cost push issue. It's not really demand related, but the cost push issue and the weather when it comes to corn and bean crops in South America make it a demand issue because you have a limited number of available suppliers. And so that's where the demand comes into play. But I like this chart a lot, Jesse, from a standpoint. It shows the U.S. consumer prices year over year, U.S. producer prices year over year. And if you notice, the U.S. dollar took a real nosedive today when we saw the consumer price index come in at 7%, the highest since 1982. And even though this inflation is probably peaking, and the chart you're looking at right now is probably a lagging indicator, and I say that because some of the more high frequency data, like the manufacturing services index, is already going down at University of Michigan. The weekly railroad loadings are already going down at this point, probably because of Omicron and a lot of the people out of the workforce right now. But I think inflation is peaking. But that is only part of the story. The really key part for the commodity trade is the dollar traders haven't really built in much U.S. inflation. They've talked about and priced in a lot of other inflation around the other parts of the world. So to see the dollar go back below 95 or stay right around 95 at the end of this week would be a real win, in my opinion, for the commodity inflation bull, and probably would encourage a lot of the funds to at least stay with their long positions and maybe attract some new fund money into the commodities, especially if the stock market continued to kind of waver and waffle around and show maybe more of a sell signal. So that's what I'm looking at here when it comes to inflation. I felt as though the two biggest pieces of the market puzzle today were this inflation number and the dollar reaction, and then the Biden administration coming in reportedly maybe changing the ethanol mandate, lowering the ethanol mandate, confirming to us by a policy change that we are tight on corn supplies. So the report actually took kind of a second seat to some of this other data when it comes to what I think prices can get to between now and when we go into the fields.
And you mentioned that news coming out here today with the Biden administration, and that it's going to segue well into the next question I was going to ask you. We got ethanol numbers out here today. Big changes in production and inventory. Production fell by 42,000 barrels a day. We saw ethanol stocks rise by 7.3% today. Talk about those numbers and maybe a little more of your thoughts on some of these news items from Washington, D.C., and how that could impact the corn market.
Yeah, that's a really good point to bring up on the ethanol data. Another piece of high frequency data. And when we talk about high frequency data, all we're really saying, Jesse, is data that comes out that's pretty reliable and comes out pretty frequently. So a weekly piece of information like the ethanol data coming in with the lowest production since October of last year, the highest stocks since mid-February of last year. This is high frequency data that says to me, even though ethanol is 20 some cents below RBOB and the profitability to blend is 25 to 35 cents, depending on where you look at it, per gallon around the country, we're still slowing that ethanol demand down. And that's a high frequency data that would say our inflationary pressures are getting tamed back in the corn market in that respect. However, the export side of the equation could really start to come into play here. And it's very necessary that it does when we see this kind of ethanol data and we see the policy issued on the domestic front for ethanol. And you add to that China's updated numbers suggesting that they may import 3 million tons less corn here in the 21-22 marketing year. So it becomes more and more and more important that weather, supply, South America, that cost push inflation remains on our side and the dollar remains on our side. So instead of all these things happening around us that make us just wonder, what do we do? What do we do? I actually see the key features and elements of this market in 2022 narrowing up very nicely that we can watch two or three things and make really good decisions on selling.
And overall, to kind of wrap up the grain side of the trade for Wednesday, at the close, we pretty much ended up about the same place we've been with price action on the board. To you, does it feel like the trade did a good job of maybe pricing in some of these numbers ahead of time off the pre-report estimates? I mean, you look at corn, still around $6 on the board, beans pushing back towards 14. What are your thoughts there, just to kind of wrap everything up we saw today?
Yeah, I think exactly right. I think that as a whole, the trade really dealt with all the data very, very nicely. And we saw the beans take over as a leader to the upside. Why? Because that Brazilian soybean crop number came in at 139 million tons. That was a million below the lowest trade guess. That was a million below CONAB. So USDA got gutsy enough to divorce itself from CONAB for a change. And I think that was a wake up call to the trade in some respects, but it kept the beans and the soy complex as the leader to the upside. Having said that, as what happened in the before the report and what's happened since 2022, we flipped that calendar year. You see the beans are having difficulty going up above some key chart resistance levels, having now filled that weekly chart gap. Why? Because corn and wheat haven't joined up with it. I don't see any changes with that, Jesse. I really think all three of them need to go up together and support each other at these elevated price levels. And I think here again, with the dollar breaking to the downside, if the Chinese currency strengthens and the Brazilian currency strengthens at the same time, we may get a shot at that, especially given that more reductions in South America in corn and in beans are probably forthcoming here in the next 30, 40 days.
We'll be very interested to see how the trade wraps up the week here. Now that we've digested the data, we'll see what Thursday and Friday brings us in the grains. Mike, I want to give us time for livestock today as well. This hog market had a nice day today, kind of recovering a little bit from some of the losses we've seen. While meantime, cattle were under some pressure today. We got some feedlot activity. But cattle committed for the weeks January 24th and 31st, that could hurt the cash market in the weeks ahead. What's your thoughts with cattle and hogs today?
Yeah, we're still reeling from the Omicron virus. And, you and I have talked about this where official news reports were that it wasn't hurting the meat packing industry a week ago. Now, official reports are it is hurting the meat packing industry with lost labor. And so I think we still have to work through that. But I did like what USDA did today on their numbers, too, Jesse, for 2022, and especially what they did on their prices. They did take the beef production up a little bit, but they took the pork production down some. Net, we saw a little bit of an increase in red meat production for 2022. Nothing we can't handle, though, especially if we have higher feed grain prices and we cut back on the weights, which that's what I'm expecting after the second quarter. Is we see a lot of weight trimming because feed grain prices, I think, are going to start getting at feedlot managers and getting at livestock managers. Hay prices, I think, are going to on their way up at this point as well. But I think what USDA did by taking the average cash cattle steer price from 135 to 137 today, and that was after jumping at $2 or $3 last month versus November. We've seen multi-month increases in the cash price for 2022. I want to say that USDA was down at about 131 or 132 a couple 3 months ago. Now we're up to 137. They've added $5+ to this market. So I really like the trend of the price for the fat cattle as we go into 2022. And I like it in terms of hedging it. If we can get a $7 or $8 premium in April cattle, in other words, if we could get 142 and move on up to 145, 146, I think that's a great price to lock in April fats and then have that cash price underneath you that maybe is supportive in a pullback on the futures and take profit on the futures. And then by the time we get to April, market that cash at that 136, 137 plus level.
I'll be very interested to see with all the Omicron worries and issues as well. We're starting to get some employees back at the processing plants. Will that give us, some increased chain speeds again? I mean, it'll be interesting to see how long it takes us to get back into the normal swing of things, quote unquote, with some of that worker absenteeism that's out there, Mike.
Yeah, and I don't think there's going to be a normal in 2022 when it comes to meat packing because Washington's already put the spotlight on the processing capacity. And so I think we're going to deal with that all year long. And this goes back to what we were talking about in the grains. It's a supply cost push inflation, Jesse. When you get that, you sell your rallies, you sell your profit, and then you take your profit theoretically on a pullback before you move your cash marketings. But this is not a demand-led market. And so this is not one of those 30, 40 degree angles where you just keep going up and have higher highs and higher lows. It's going to be really rocky, really jagged, and you're going to have parabolic moves up most likely. And then those parabolic moves, those straight up moves almost, you want to get hedged on. And so I think you're going to have to be very, very active in 2022. But I think unlike 2021, I think we've got fewer factors that we're going to have to watch out for because we've learned a lot after 2021.
Well, Mike, we covered a lot today. Floor is yours here for the final minute or so. Any thoughts that we didn't touch on that you want to mention today?
I think I'm getting more excited about 2022. And whenever I do that, I have to be very, very careful that I'm not missing something, Jesse. But please pick up a subscription. If you don't want to work with me on a brokerage or cash only basis, at least pick up a subscription so you can keep track of some very important data that won't be overwhelming to you, that I think will help make better decisions in your markets, whether you're a farmer or whether you're a rancher. I think we can cover a lot of bases without spending too much time on it. So go to globalcomresearch.com and take a look at what we do and give me a call if you have any specific questions.
Well, Mike, I appreciate the thorough analysis and recap of all the data here from the day today, and I appreciate the time as always. Have a great rest of the week, sir, and we'll talk to you next week.
I thank you for everything, Jesse. Thanks for having me.
Mike Zuzolo with Global Commodity Analytics, our guest today. Find him online, globalcomresearch.com. That's going to do it for the Wednesday, January 12th edition of the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.